Hello guys, in this video we are going to talk about another backtesting method, and here we are going to talk about Renko technical trading backtesting method, and here we are going to do a positional backtesting instead of intraday backtesting. Now Renko is a new kind of charting system which was developed by the Japanese. It is slightly different from your candlestick charting system. Now if you want to learn more about Renko charting system, how the charting system is built or how the bars are plotted in the Renko, we will give you some links to our videos on Definedge channel where all these things are explained in detail, and what are different indicators of Renko charting system and how they are used in trading. Those are all there in on our YouTube channel, so please go out and check them. Now I'll briefly show the Renko system here and what we are going to do in this particular positional backtesting using Renko charting system. Now you can if you go to Definedge securities on RZONE and open any chart, you will see different kind of charting system. So we are simply using the Renko charting system, and here we are going to use an indicator called as MAST. Okay, so it's nothing but a moving average super trend indicator, where simply it's a combination of those two, moving average and super trend. And in this system we have a cloud like this, okay, and we call this as MAST Cloud. And here, and this is a Renko chart, and if I hide this, sorry, I cannot hide, but let me check if I can hide. Okay, yeah. So this is a simple Renko system, right? And now it has these bars, okay, using these parameters, and here the box size is 0.05%, okay. Now for more details, as I said, we will link to those Renko chart systems videos. Now I'll add the MAST system, okay, from my template, and we have this MAST Cloud. And the trading system, the backtesting system that we are going to use is very simple. Now if the bar, okay, the Renko bar closes above the MAST, okay, the bullish MAST here, can you see that, right? Closes above the bullish MAST, okay, like it has happened here, then we go long, and then we exit this when it goes below this bearish MAST, which is here, okay. So we are staying in this trade from here to here. Now this is done on futures, Nifty continuous futures, okay. So this will be the trading system, but instead of doing it on futures, we are going to do this on long call system, on a long call strategy, okay. Now using this system, I'll show two different strategies. Now here, Renko technical trading, long strategy and Nifty. We'll do it for 2 years, and we use monthlies, okay. Now the technical signal generation is based on futures, because here we are using the futures for generating this signal, right? Signal above bullish MAST and below bearish MAST, which is in red color, right? Okay. Now if you come here, our entry condition is future price crosses above bullish MAST Cloud, add, okay. Now exit criteria is exit on rate criteria. Here the strategy price or actually in this case future price crosses below bearish MAST Cloud, then add this condition. Okay. Now we do the back testing. Now this will take some time because the chart has to be generated in Renko in the futures to generate the signals, and then we have to come back to the options and then choose the right option strike on the right expiry, and then we enter and exit as per our trade entry and trade exit signal. Okay. Now these are the criteria based on which we are going to enter multiple trades in different expiries and see how this system works. Now it will take some time, as I said. Now here, based on this signal, we are entering a long call. Okay. Now long call in this case will be at the money strike price. Okay. So whenever the signal is generated, we choose on that particular date the at the money strike price of that particular monthly within that period. Okay. So let's say in this case, for example, just for an example, this signal came on, if you see the dates, okay, above the high date, it's on 14th of February. Okay. On 14th of February, so that will be the monthly expiry will be 29th February. So I'll choose at the money strike price of 29th February on 14th of February around 1 o'clock, I believe. That's the time where we got this signal, okay, this high signal, and then I enter that particular trade. So that's how we enter in these particular trades. Okay. Now as you can see here, the average capital employed is 20,000 because we are only taking a long call. We are assuming that it may not be more than in a given trade. It will not take more than that particular amount to enter the trade. Number of profitable trades, number of loss trades, and number of total trades. This is the brokerage that was required for the whole backtesting. So considering 60 per for entry and exit. The gross gains were around 4.5 lakhs and gross losses around 2.84 lakhs. Now the win rate is low because this is a trend following system, right? So in the trend following system, always the win rate is low. When we win big. When we lose small. Okay. So that's a benefit of this trend following system, and that's why you see low win rate. Now the expectancy is negative. Okay. When the expectancy is negative means in the long run this may not work. That the amount of gain that you gain for the amount that you risk is negative. Okay. So that's why the expectancy is negative here. Now the maximum profit in a trade is around 38, almost 40,000, right? That's huge. And the maximum loss in a trade is 6,340. Small losses, but we'll have big profits like this in this case. The maximum drawdown in this case, in this particular backtesting system, is 44%. So from peak to trough, okay, that will give you the maximum drawdown. So this is the equity curve. Again, you see at the beginning, right, 44% of drawdown, and overall the equity curve barring the beginning one has been positive and has been going up. Okay. Now the returns, if you see 832% returns. This is considering that at any given time we are only putting in 20,000 of capital. Okay. Now the average returns is 3.75%. Okay. So 750 divided by 20,000, that will give average returns. Now total P&L is around 1.66 lakhs. This is over 2 years. Okay. All right. Now again, this is the breakdown of the trades. This is a yearly calendar with each month breakdown, and in each month we have, like, the number of trades and the P&L. Okay. Now the highest, I believe, is happened in November of 2023, 57,000 in 1 month, just from 2 trades. Okay, if you click this, you will see just 2 trades. One is 19,000, one is almost 40,000. 2 trades gave this much of P&L. Now, and again, if you go and you can look at each of these individual trades. Okay. Now, so in November, let's go and look 2023, which is on Thursday, 2nd of November. Okay. We'll see the trade C and how it worked out. 2023, 2nd November. Okay, this list gives the list of all the trades that are there in the backtesting. Okay. So 2nd November to 11/2023. Okay. So here 19,200 call. Now I click on this and then the chart loads and the whole trade loads at each and every minute, and see how the P&L has generated over time. Okay. Because huge amount of data is being loaded, because this data is from 2nd of November to 17 November. So 1 minute data, so it is loading all that data. So it takes some time. Okay. So now, as you can see, it's a huge amount of data. So basically what happened here is, we entered our long call when the futures price was 1920, 225, and exited when the future price was 19,805. 805 minus 225, almost 600 points of gain that we did using the long call option. Okay. Now again, you can simulate this if you want. Okay. So we entered here, and then we go to final exit time, and we have this much P&L. Okay, we have to go, and then here is a position chart. How the so we bought when the strategy was around 230 price. Okay, and we exited when it reached 640 rupees. Okay. All right, so that is the anatomy of that particular trade. Okay. Now, since we saw this as a negative expectancy, because what happens in a trend following strategy is that there will be a lot of time where the market is sideways, and since you are taking long call option, there is a theta decay, right? When nothing happens in the market, the value of the long call goes down if nothing happens. So there is a theta decay risk when we are doing the long call option. Now, can we make it better? Instead of doing long call, we do a short put, which is also a bullish one, right? So again, we do the same. We keep everything same, 2 years, technical signal generation based on futures, and then enter when it is above this thing, and exit again future price crosses below this thing, bearish MAST Cloud. Okay. Now the brick size is 0.05. You know, in the Renko we call the what we plot is called as a brick. So that is 0.05, and here the margin required is higher. It's around, based on current requirement, is around 1.3 lakhs. So we can, depending on how much is required with your brokerage, you can change this. So we can make it as 130,000, let's say roughly, and brokerage is 60 for entry and exit, and then we start the backtesting of this, and everything is same. You know, for example here when it is sideways, for example here when it is sideways, this might lose. For example here we entered here, the market has been sideways, right? So this can be, you know, cause loss in the case of long call options. So instead, if you do a short put here, even if it is sideways, okay, because the short put is we gain from that when there is a theta depreciation, right? So in that case we will gain if it is sideways. So that sideways risk is reduced when we do a short put instead of a long call. But there are two risks there. One, the margin is requirement is higher, so your overall returns might be lower compared to do a long call option. And two is that there can be unlimited, you know, undefined risk if there is a huge gap, in this case gap down, right? Now the results are here. Now here you can see the overall returns there in the case of long call is around 800%, right? Is 100% only. That is because the margin required is much higher. But the good thing is here your expectancy is less, 0.1103, okay, and expectancy is positive, okay, and then your drawdown is also less, it's only 15%, okay. The max loss was around 6,140 max drawdown at any given point of time, okay. Now the win rate is slightly improved in compared to long call only, and yeah, so overall the total P&L is 1.37 lakhs. We have positive expectancy and profit factor is 1.52, and yeah, so those are the two differences between when you go with a long call and when we go with a short put. With long call we had a negative expectancy, with short put we have a positive expectancy and also a better win rate. But the total returns wise it is lower because the margin requirement is much higher. That's the only difference. Okay, so I hope you find this backtesting method useful, and not just this bullish MAST Cloud, there are other indicators that you can explore using the Renko system, charting system with different indicators and patterns in the positional as well as intraday. Okay, thank you guys, have a great time.